So we already started spot markets. Spot market is whatever price is available in the market. We use it to trade, to buy or sell, or bid and ask. So in spot markets, we have different kinds of information in relation of foreign exchange, such as spot rate quotations. Under spot rate quotation, we first of all under spot rate quotation, we understand. Spot rate quotation basically tells us how to read dollar, pounds, what does it mean, or pounds, dollar, what does it mean, right? That's normally we read it. Of course, this is American terms, and this is a European terms, right? So and the conclusion is American terms, which is direct quotations, equals to 1 divided by direct quotations, which is indirect quotations, right? Not really equals to, but if you want to calculate indirect quotations, which is indirect quotation, so indirect quotation will be reciprocal of direct quotations. Right? So that's what we looked at as spot rate quotation. Of course, we also learned how to read it, these kinds of exchange signs, right? Then cross rate exchange quotations. Cross rate exchange quotation means, for example, you have some position in pounds and you want to convert into euro. So with the help of USD, you will change it. So that's called the cross rate quotation. So converting one currencies into USD and then USD to another currencies. Right? So let's say you have Vietnam dong to USD, and then USD to, let's say you have Canadian dollar. Right? So that was cross rate. That's we already finished the last session. And then bid and ask spread, right? Bid and ask means buy and sell. So buy and sell American terms and European terms. Remember, American bid and ask, and European bid and ask, right? So what we studied, that American bid, which is buy, equals to European ask, all right? And American ask equals to European bid. So it's like maybe like this. So that's gonna be equal. That's what we looked in the bid and ask spread. So bid and ask, you can use American terms, which is direct quotations, or European terms, indirect quotation. Whatever options you have available, if you have both American and European, and you want your position in European terms, non-USD currencies, then I prefer to use direct quotations of the European terms, so you don't have to worry about divide and stuff, all right? Same thing, if you want position in American dollars, then I suggest you to use American terms. You don't have to divide, or you don't have to reciprocal, because sometimes when we use reciprocal, you're probably confused. Reciprocal for ask price or bid price, right? So try to make it simple. If both are available, then try to use the direct quotations either for American terms or direct quotation for European terms. It's easier way to find the position in American dollars or in non-American currency. And that's all about bid and ask spread. So I guess last we stop here, bid and ask spread, right? So we also finish. So in today's session, we will study about spot forex trading. Spot forex trading is just a trading floor. How trading floor look like is, of course, is a trading floor. It's really noisy because many buyers and sellers are willing to buy and sell different currencies, and one currencies last for maximum 10 minutes, and normally it's changed in a 10 seconds. Right? So it's similar to the shares. And then we move on to the cross rates. In cross rates, we will study about arbitrage triangle, right? So, but before we start this spot rate, which is 1, 2, 3, 3 and 4. Before we start this 3 and 4, anybody has any questions regarding whatever we have covered in the last session? Any question, anything is unclear, especially from bid and ask spread, which is one of the most?
Do you have a solution for exercise number 9 on page 135?
From your textbook?
Yeah, from our textbook.
No, I do not have a solution, but I think I have to solve it first. All right.
Yeah.
So what I will do in today's break time, I will solve whatever. Oh yes, now I remember last time I gave you some activities. So in the break time, I will solve questions, and after break time, I will disclose you answers, and then you can check whether your question is right or wrong.
Okay, thank you.
Okay. So any other questions related to the previous sessions before we move on to the next? So if no questions, so can we move on to the next? Sport foreign exchange trading?
Yes.
Okay. Okay, so here is the sport foreign exchange trading. As I mentioned you before, these kind of transactions occur interbanks, from one bank to another bank. So one bank may be buying, involved in buying foreign currencies or selling foreign currencies, right? So its transaction is nearly $10 million, right? As I mentioned, that bank trading room is a really noisy, active place because many people are willing to buy and sell in a foreign currencies, right? Stakes are high. Stakes means a bid. Buying and selling is quite high. People, as I said, is at $10 million. And the long term is about 10 minutes. Long term, we also call it long position. So people maximum keep it for 10 minutes. This long position we will study in the forward market. So after we finish spot market, then we move on to forward market. So under forward market, you will understand long and short. So long means buy and short means a sell, right? So this is just a very general information. So you don't have to worry too much about it. Let's move on to the next, which is the cross rate, the last point for your spot markets. Suppose that S, here they are using S. S means spot market, right? Spot market. So right now the dollar over euro is 1.50. So which means the price of $1 equals to 1.50 euro. And then dollar over pounds. So price of £1 equals, sorry, price of 1 pound equals to $2.0, right? So you know that, right? So that's normally do that. What must be, so this exchange rates, so you can see that this exchange rate, dollar, euro, right, and dollar, pounds, right? But what if you want euro, pounds? If you want this exchange rate, the benefit of this exchange rate is that you don't have every time you do. Let's say if you have euro, and you want your position in pounds. So every time you have to go through with USD. That's the meaning of cross rate, right? Every time you have to go through with USD to get your position of euro into pounds. All right. So one of the advantage of finding these exchange rates is every time you don't have to go through with this process to get your position either in dollars or pounds. So we can also calculate this one using these two types of exchange rates, right? Because you will convert, you have a euro, you convert in dollars and then dollars to pounds. So why don't we just find exchange rates which directly help us to convert euro into pounds, right? That's this question is about. So what is the exchange rate for this one, right? So which means 1 euro equals to how many pounds, right? Sorry, 1 pound, sorry. 1 pounds equals to how many euros? How many euros? That's the questions, right? 1 pound, this position, this exchange, 1 pound equals to how many euro? So we can do that. But before we find this one, let's do this question. With the help of this question, we can find the answer of this question following this example. I think I added this information in these slides. I guess you do not have this information, right? But if you don't have, so don't worry much about it. So we can read and understand what exactly meaning of this. So it says that using exchange rates given in next slide, find following things. So we need to do this 1, 2, and 3 using information in the next slide. You have the same slide. I didn't make any changes in this slide. All right. So this and this. So first of all, you have to convert 10,000 pounds into euro. All right. Going through USD or find exchange rates. All right. Whatever options you prefer. But I suggest we should find this rate, right? Second thing is you have position in euro, then convert into pounds, all right? And third, find bid and ask price for euro pounds using American terms and European terms, all right? Bid and ask, so American terms, bid and ask, and European terms, bid and ask. So we also have to calculate the complete quotations for Americans and Europeans. So you have to find bid and ask price for American and European terms. So that's what you have to do, 3 things. So for first, this one, it's a next slide. It's a next slide for this first point. Next slide is whatever slide number, I don't know what slide number is it. So this is the next slide. And this one is next to next slide. Which one is here, all right? And this one is a third slide, 1, 2, and 3. So this is the complete table. So you have to, this information is given. This information is given. So you have to calculate only this information, right? So let's start with the this question. So here is the exchange rate informations we have complete. So here is this is the pound, Americans, and euro. So what does it mean? It means 1 pound equals to $1.97, right? So this means USD divided by pounds. And here, USD divided by euro. So always remember, if USD is numerator, so which means it's a direct quotation. In direct quotation, USD is a numerator, right? And non-USD currency will be denominator. Denominator means the bottom one. If non-USD currency is numerator and USD is a denominator, which means it's a European terms. So under European terms, non-US currency will be top and US currency will be bottom. So one USD equals to 1.97 pounds if you buy. And if you sell, it's 1.7. I guess the short figure, small figure and big figure. So as we learned previously, big figure, same, but small figures indicates the bid and ask spread. So for euro, 1 euro equals to 1.47 USD for bid, which is 38, and ask is 42. So bid and ask spread. Under European terms, which means indirect quotation as per American terms. All right. So bid is this, or 1 divided by 1.9717 is this. All right. Ask is 0.5073, or 1 divided by 1.9712, right? It's too slow. Okay. Now, so this is the information. Same thing for euro, bid or 1 divided by 1.4738 is ask. Ask or 1 divided by 1.4742 equals to 0.6783. So this is the informations we have. All right. So now the question is, convert 10,000 pounds into euro, right? So what we're gonna do, we will convert, we have 10,000 pounds. So what we're gonna do, we will convert into USD by buying USD. All right, so we are holding 10,000 pounds. So if you wanna buy USD, so you're gonna use a bid price. So bid price is 1.9712. So 10,000 multiplied by 1.9712. So you got, so let me write down. So we got, so what we are doing, we are converting 10,000 pounds into euro. Right. So step one. Under step one, we are converting 10,000 pounds in a dollar. So which is dollar 1.9712, I guess. Yes, 1.9712. So if you do that, you got your dollar position in 19,712. All right. So what we are doing here, we are using direct quotation of American terms. Since we are buying USD, as I said, all right, or you can use indirect quotations of of European terms. So which means 1 divided by 1.97, not 1, 2, because ask, right? Whatever is the ask, right? So that's what you can do. Or you can use indirect quotations, whatever you like. Quotations. That's the first step, we got it. So we got this dollars. Now what we are doing, we are converting now step 2. Step 2. One, this is step 1. Then dollars, step 1, and this to this is a step 2. Now we are performing step 2. So under step 2, we got $19712, right? So now what we are doing here now, we are buying a euro. So if you are buying euro, so simply use indirect quotation for American terms or direct quotations of euro terms, buy, which is bid. So let's have a look. So here, so you can use this, as I said, or bid of European terms, right? The bid of European terms. So you can either buy this one, I guess. Yes. So we can use, so what we are doing now, multiply by, we are buying 6,783 euro, right? Which means the value of £1 equals to value of 1 euro equals to that dollars. So we are buying it. So what is the, yes. So if you multiply by this, you will get 13,370.65 euro. All right, same thing for here. So remember, in this question, I use indirect quotations because here I'm also using, sorry, yes. So in this question here, I am using direct quotations for American terms, and this one direct quotation for European terms. So this multiply by this and then multiply by this, then you got this position 13,370. All right. So what does it mean? 10,000 pounds equals to 13,370. Right. So 10,000, conclusion is 10,000 pounds equals to 13.37 euro. What does it mean? It means £1 equals to 1.3371 euro. All right. How you will write down this one? Can you tell me how you write down this? £1 equals to 1.3371. How are you going to write down? So you're going to write down euro divided by pounds. So which means £1 equals to 1.3371. Right? And this is, what do you think? Is it American terms or European terms? Remember the questions, what we have to do? You need to find the exchange rates. You have to find the exchange rate. So we already got exchange rates, which is this 1.3371, right? So we got exchange rate, and then you have to find, is it, you have to find European, Americans, European bid and ask, American bid and ask. Can you tell me this, we should call it American terms or European terms? This exchange
term.
Sorry?
European term.
So what will be American terms? What will be American terms if this is European terms?
One divided by 1.3371.
No, this is not a European terms. This is American terms. Why it's American terms? Because we are estimating this number using American terms. So this exchange rate will be American terms. Let me write down here. Let me show you in the lecture slides. Look here. What's this? American terms. Exchange rates, American terms. All right. So using American exchange rates, whatever rates you're gonna get it, that will be American terms. All right. So this is American terms, not a European terms. All right. I repeat, this is the American terms. All right. All right. Okay. So let's move on to the next. So remember, one exchange rate, we got it. And this is your bid. All right, remember, it's a bid. So we got bid. Next. Now, same questions, but now second points. Second point is convert euro into pounds, right? So start with euro, sell euro for dollars, and then buy pound. Exactly what we did in the previous slides. So you have euro, you're gonna sell it to dollars, all right? You're gonna sell it to dollars. So what does it mean? It means you have two options. You are getting dollars. You want your position in dollars. So you can use direct quotations using American terms, or indirect quotations using using European terms. As I said, I prefer to use direct quotations using American terms. So instead of doing this, you can write 10,000 multiplied by 1.4738. So let me write down in the, yeah. So you got 10,000 euro. You want your position in pounds. So step one. So you have 10,000 euro multiply by 1 point. So what is exchange rates? Yes, 1.47, 1.4738. So you got $14,738, right? So dollars. So we are using indirect quotation from American term, European terms point of view, or direct quotation for American terms point of view. Then step 2. So you got $14,738. Now we want your position in pounds. So we have two options: use indirect quotations of bid, or direct quotation for European terms, which is ask, selling, right? Selling USD. Right? So we are doing the same thing. So 1 divided by, no, so we are using direct quotations. So we are using direct quotation. So what is the exchange rate? 0.5072. 0.5072. Why? Because we are buying. We are buying pounds. We are buying pounds. We have dollars, right? So if we have $14,000, so we have to convert into pounds. So we are buying pounds using the bid price according to European terms, or ask price American terms. So if 14,735 multiplied by 0.5072, your position will be in pounds is 7474.96. Right? So 10,000 euro will be equals to 7474.96. Right? So now we can find cross rate, or we can find exchange rates between euro and pounds. So exchange rates will be, what does it mean? It means 1 euro equals to 0.7475, right? Or 1 pound equals to 1.3379. How you got this number? You're gonna reciprocal 1 divided by 0.7475. Right? Yes, if you say reciprocal it, you will get this number. So you got the same. Why I am converting, why I'm getting this one? Because we are using the American terms. So according to American terms, this is the ask. Because if I leave my answer using this rate, if I leave my answer using this rate, that may not be equals to the American terms that we calculated here, because that's American terms. We calculated using American terms, right? And if you use this exchange rate, 0.7475, so this is European terms. So in order to convert European terms, so 1 divided by European terms equals to American terms, right? So that's the reason I am converting European terms into American terms. So now we got American terms, bid and ask spread. So let's go to slide and check what they're doing on the slides. Yes, so they are doing similar things, or they are using indirect quotations. So they are using indirect quotation, but in my explanation, I use direct quotation. It doesn't matter direct or indirect, your answer will be same, 7475. So this is the exchange rates. They got it, right? This is the exchange rates. They got it. 1 pound equals to 1.3379 euro, which is the ask price. So we got bid and ask for American terms. Now what we have to do, European terms, which is much more easier. Once we got American terms, then of course you can calculate bid and ask spread for European terms. So we got bid and ask. So bid and ask American terms that we just did it. 7.8 or 7.9, I think it doesn't much make difference. So if 7.1, 7.8, if 7.0, 7.9. So it's nearly same. So now what I'm going to do, I will reciprocal 1 divided by 1.3371. So I will got this number. I'll get this number. Or 1 divided by 1.3378, I will get this number. So let me write down on the. So here is number 3. So we got American terms and European terms. So American terms, bid and ask, bid and ask. So bid, so bid is 1.3371, 1.3371, and 1.3379. And here bid is 1 divided by 1.3379 and 1 divided by 1.3371. If you solve it, you got 0.7479, and here 1 divided by 1.3379. So you got 0.7474. So that's your answer, right? That is your answer for number 3. So remember, in your exams or your assignments or anything, I can ask you this, complete the table. All right, so you're gonna complete your table in this sense. In this sense, all right? You will complete your table. So these informations are given using dollar quotations, and this information is given using euro quotations. I mean, yes, euro, or direct for one and indirect for the others. All right, so that's the whole ideas for your cross rate bid and ask spread. So we study about cross rate first, and then cross rate bid and ask. Under cross rate bid and ask, we don't have to convert into a dollars every time. So we can find a one rate that's help us to directly convert into cross rates, right? And one more thing, that's the practical or my experience regarding the currencies. So remember, if the currency is a well-known currencies, right? Popular currencies, lots of international transactions occur in that currencies, then banks will give you cross rate for bid and ask spread. So every time bank may not convert into dollars to get the money in that currencies. But if that currencies is a less popular or least popular in that country, then they more likely to get in dollars and then in pounds. Like is my experience. Last time when I need an Indian rupee, so I went to bank. So what bank they did, I asked them the way they are using the exchange rate. So what bank did, Vietnam Dong, they convert Vietnam Dong into USD and they give me USD. Say, oh, this is the USD. So this is the value of Vietnam Dong that you want to convert in rupee. So they give me the value of USD. And then they look at the buying price of Indian rupee. And then they convert USD buying price into an Indian rupee. Right? That's what the procedure exactly they did, what we are doing here. Why? Because in Vietnam, probably Indian currencies is not so popular in terms of buying and selling, in terms of trading, in terms of transportations, in terms of exchange rates point of view. It's not so popular. But if you take example for let's say Vietnam dong to pounds, so maybe there are lots of transactions occur between Vietnam and British pound, right? Or Vietnam or euro. I guess euro not so popular, because last time one time I also had bought a euro. So they did exactly the same thing what they did for the Indian rupee. So they convert into USD, and then they find the buying rates for euro, and then they convert into euro. But they didn't mention any kinds of this kind of table. They simply telling me that this is the exchange rate and you can see. So sometime when you go to bank, they are giving you exchange rates. So most of exchange rate are cross rate spread, right? So they use as far as I know, whenever I go to bank, whenever I look their screen for exchange rates, so most of currencies they use, of course, USD, Australian dollars, Japanese yen, and what else they use it? They're less likely to use a euro, yes, and pounds. So these four currencies are quite common. So in the most of Vietnamese bank, they give the rates for this four currencies. So USD is obvious, but other three currencies, the Japanese yen, euro, and no, not euro, Japanese yen, pound, Japanese yen and pound. So these two currencies they mostly use it. And yeah, and Australian dollars, yes. They also give Australian dollars. So every time you don't have to convert into Vietnam dong to USD to get Australian dollars. So they're actually giving the rates for Australian dollars. So this is the ideas for cross rate bid and ask, right? So before we move on to next, anybody has any question? Or we move on to the next? Move on to next, or any question?
How do you know that for the second, for the second case, when you convert 10,000 euro to pounds, you know that it's the European term instead of American term?
This one?
Yes.
This number?
Yeah, because I can see that you did do the reciprocal of it to get the American term. So how do you know that that number is in European term?
You mean, how do I know this one is in European terms? That's what your question, right?
Yes.
It's very obvious, because remember, if your position is in non-European currencies, that will be American terms, all right? Or American terms point of view. Okay, let me clear one thing. American terms not always means American dollars, right? European terms not always means euro or pound. So let's take example of Vietnam dong and Australian dollars. None of these currencies is American currency or European currencies, right? So remember, if your position you got in Vietnam dong, that will be American terms. Or opposite, 1 divided by Vietnam dong will be European terms. So now here you can see that you are looking for European exchange rates. So this position is a non-European, all right? So which means here, this is your American terms. So non-European will be European terms, all right? So let me write down. How do I know? So I repeat your questions and then I explain. So how do I know this 7474 is European terms? That's your question. How do I know? Right? So if you want your position, I repeat, if you have euro, so there is no any dollars, all right? So no dollars. So euro is American terms. Non-euro will be European terms. As I said, European term doesn't always mean that euro currencies. If euro and USD, yes, is clearly American terms, and this one clearly European terms. But in these two currencies, none of these is American. So if you are using euro, so euro, you can treat euro as American terms, right? So if whatever position you are getting in non-euro currencies, that will be treated as obviously European terms. So let's say instead of European terms, I'm using Vietnam dong, and here Australian dollars. All right. So if you are in Vietnam, you are in Vietnam. So this is your American terms, all right? And this is non-Vietnam dong. So non-Vietnam dong is a European terms, right? No. So if you are converting Vietnam dong, which is 1 million Vietnam dong to, I don't know, let's say uh, um, $60, 60 Australian dollars. So obviously this $60 is a European terms, obviously, because Vietnam dong is the American terms. All right. So if I got my position in pounds, So obviously this pound is a European terms. So which is 0.7474, because my position is in pound. So this is non-European. Non-European means European terms. European means American terms between this European and the pound. All right. I guess it's clear now.
Yeah, thank you.
Right. So always remember that conclusion is euro is not always European terms. We are using these terms to present what is your home currency. So your home currency always American terms. Foreign currency always euro terms. Right? Always euro terms. So remember that. So if you are Vietnamese and you are living in Australia, all right? You are in Australia, so Australian dollars will be American terms, right? And Australian point of view, Vietnam dong will be European terms. So obviously, they are opposite to each others, all right? For example, I'm living in Vietnam now. American terms for me is Vietnam dong, and Indian rupee is the European terms. If I'm getting my position in rupee in Vietnam, so that will be treated as a European terms for me. So I have to convert 1 divided by Indian rupee to get a Vietnam dong. So that will be in the in American terms. We are doing exactly same thing. 1 divided by pounds to get euro, which is the American terms. All right, 1.7474. So we got 1.37 something. All right, so that's the reason to find, is it American or is it? So look at the sign. Look at the sign of your position. In Europe, your sign is pound. So this is European terms. if your position is bound in Europe, right? If you receive American dollars, I repeat, you receive American dollars in Vietnam, so that American dollars will be treated as a European terms in Vietnam, right? If you receive position in Vietnam dong, so that will be treated as a American term. So your home currency is a American terms, all right? And foreign currency is a Euro terms. Not USD is always American terms. We are using USD as American terms is because it's very easy example to understand it. But when you are converting Vietnam dong, Singapore dollar, or Canadian, then things gonna be more complicated if you do not understand this. Right? So that's why this one is very important. Right? Conclusion. So home currencies could be America, home currencies could be Euro. Right. So that's the ideas. Right. I hope it's clear now. So any other question before we move on to next? Any question or we move on? No question. So let's move on to the next. Okay, so triangle, why we call it triangle? So let's say you have Vietnam dong, right? And you want your position in pounds, right? So one option is you do that using cross rate, right? Using cross rate, right? So which is dong pound, right? So one option is this, right? Second option is you will dong to USD and then USD to pound, right? Dong to USD. So depends, direct, indirect quotation, it depends upon. It's too slow to me. So right, up, down, and then right. So if you choose this option, if you choose, so option one, root one, and root two, root two. If you choose root two, this is called triangle arbitrage. That's the meaning of triangle arbitrage. Using that, so we also call it bid and ask, cross rate bid and ask. Cross rate bid and ask means you buy one, sell another one, and then you buy and sell foreign currencies. This is called bid and ask spread cross rate. Bid and ask means you are buying and selling foreign currencies to get your position in the final currencies. But here we are not using bid and ask spread because you're directly finding cross rate to convert dong into a pound. So this is, so the idea is that you have a chance to make a profit. Profit is possible if pound and dollar and pound are not consistent. If they are not consistent, then you have a chance to make profit. All right? If dollar and pound, they do not move in the same directions, then you have a chance to make profit. So if you're making profit, this is called triangle arbitrage. So we have also questions for triangle arbitrage. So let's have a look at question. So triangle arbitrage is the process of trading out of USD into second currencies, then trading it for third currencies, which is traded for USD, right? So which means using the third currency. So that's why it's a triangle. Now here is a question. You have a bank quotations are given. Option 1, you choose these. You have a pounds. You want your position in euro, right? So option 1, no arbitrage, direct cross rate, like as Vietnam dong to pound. So direct pound euro. Second option is pound dollar, euro dollar, and pound euro. If you choose this route, so there is a difference between, you can see that exchange rates here and here, converting the same thing. All right, position is the same. All right, quotation is the same, but the bid price of quotations are different than the price. The reason is a arbitrage opportunities. All right. So suppose we observe these bank posting these exchange rates. As we have calculated that no arbitrage pounds, cross and bid ask rates, so we can see there is an arbitrage opportunity. There is an arbitrage opportunity. Of course, that's why exchange rates are different. But how is different? How we got this exchange rate? We know how to calculate this one, right? We know how to calculate this. Like as the previously we used 10,000 to 1.337 something. So let's have a look the real question. So here is your real question. This is just explanation to get this number. So explanation to get this number. We know that how we get this one. So directly move to the questions, which is arbitrage. So start with 1 million pounds, sell pounds to Deutsche Bank, right? For these dollars. So these are the exchange rates offered by the different banks, right? So you are buying USD. You have a pounds, 10 million pounds. 1 million or 10 million? I think 10 million. It's not 1 million. So you can fix this 10 million. Or 1 million. I guess it's a 1 million. Anyway, we will see later. Okay, so start with 10 million, sell pounds by buying USD. So we are buying USD, simply using a buying rates, right? Now we got dollars, right? So remember, this is direct quotations, right? Direct quotation. So we are dollar. Now we are getting position in euro. So we will use indirect quotation, which means 1 divided, this is direct. You can see dollar sign, so direct quotation. So we will 1 divided by direct, we got indirect quotation because American terms indirect because sign is in USD. So 1 divided by 1.4742. So you got euro, this euro. For 10 million, you got 1,337,132. Okay, so now how much profit do we have, right? So if you got this euro now, if you sell this euro at exchange rates, you will get this pound. I repeat, if you sell, you already got position in this money. If you want to make profit, you will sell again. All right, you will sell again. When you sell it, you will get this money. At what price you're gonna sell it? You will sell it at 1 divided by 1.3317. All right, this is the indirect quotations, right? Because you are getting position in pounds. So non-pound currencies is the indirect quotations, right? So you can convert this money using this exchange rate, 1 divided by this exchange rate. Whatever number you get it, that number will be in pounds. All right. So pound, USD, euro, and then again pounds. So when you again pounds, that money may not be same. Let me write down, explain you here. So we have pound, convert in dollars, and then we got euro. When you convert this euro in this pound again, so you started with, for example, you started with 1 million pounds or 10 million pounds or whatever. So let's say 1 million pounds. You sell 1 million pounds in dollars and then sell dollars to buy euro. Now you sell euro to buy pound. When you will buy pound, this money, this pound will not be equal with this pound position. So let's say, I don't know, it's 1.04, for example. So when you sell this one, this position will not be equal with the position you started at the first time, right? So the difference is a profit. Difference is the profit. That exactly we are doing in the slide, right? Exactly we are doing in the slide. So we have, I think it is 1 million, I guess. Yes, it's a 1 million, not 10 million. It's 1 million. Right? Okay. Yes, the 1 million. So you sell 1 million, but later you got when you convert this euro into pound, you got this number. So what does it mean? $4,078.89 penny, pounds, 0.89 penny. This is your profit. And that profit happened through this triangle point of view. That's the meaning of triangle arbitrage. Right? So we can make profit. So most of people, they normally make profit by doing this, right? So make profit by doing this. So you can understand with the help of dong. So you sell dong to buy USD to convert into pounds, and then you sell pounds to get your position. So you start here and you end here by doing this. Start from here and end here. So these two numbers may not be equal. And obviously, if it's equal, is in the positive direction, so it's going to be a profit. If we have profit, then we do that. If it's not profit, then we directly use exchange rates, which is pound to dong to pound. So we're not going to arbitrage. We're not going to buy and sell to make profit. We also call it import export. The people normally, they do import and export. They import it, they make changes and export it. So there is a difference between import and exports, right? So this is the ideas for arbitrage, triangle arbitrage, right? So arbitrage triangle is finished. So any questions regarding arbitrage? So that's the conclusion. Right? So that's the conclusion of using the different exchange rates for arbitrage.
Do we have any quick way to know if there's an arbitrage opportunity or not?
Yes.
Instead of just going through the whole process.
Yes, we have. So as I said, let me write down. We have opportunity. We have two ways. Option one is you directly find dong to pound. This is cross rate. You get this exchange rates and then pound to dong. You have dong, you convert into pounds, and then you sell pounds to convert into dong, and then you check. It's no profit because it's a cross rate, all right? You don't have any profit, no profit. And then you will choose another option. You dong to dollars, dollars to pound, and pound to dong. And then you will see you have profit or not. So you can find the two ways because this is the cross rate is given in bank. As I explained you before, cross rates are given in bank. Bank will not tell you this. This one you have to find by yourself by asking dollar rates. So these two rates you need to go to ask bank. Bank, option one and option two. Bank will not give you options two. You are a trader, you have to find option two by doing that. So yes, you can find by yourself by directly doing dong, pounds, dong, or dong, dollar, pound, dong, or dong, pound, dollar, euro, Japanese yen, and then dong again. So it's not really, triangle doesn't only mean that just three currencies. It could be 4, 5, 6, 7. So you can experiment by getting the different exchange rates and find the root. So first of all, you have to check which currency has a high fluctuation. So remember, if any currencies has a high fluctuation, fluctuating currencies, so you have an opportunity. Maybe you have opportunity because rate is not consistent. So you have to find first which currencies have a loss of fluctuation. If any currency have a loss of fluctuation, then you may have opportunity. If any currency has a less fluctuation, you have a less opportunity. So by looking at the fluctuation of the currencies, we can find the opportunity. All right? Is it clear?
Okay, thank you.
So that's any other questions regarding triangle arbitrage? Any questions, or we go for break now?
No question.
No questions, so we go for break and then we will start, I guess, forward rate, a forward market, sorry. Yes, forward market, which is more about graph-based explanations, all right? So we go for break now and then we will start again. Of course, there is a difference between spot market and forward market. Is spot markets mean whatever price is available in the market, we use that price to trade. So that's the meaning of spot market price. But under forward market, we sign a contract for future delivery, right? We sign a contract for future delivery. So maybe we sign a contract to buy in future, right? And let me check. I sent email to the, under forward market, so we're gonna sign a contract for the future dates. So whatever is the spot price in the future, we're not gonna pay that spot price. We pay the spot price that we have decided in a contract. All right, so that's the meaning of forward markets. But of course, if you want to calculate profit and loss, you will look at the spot price. So let me explain to you. So, for example, you buying a raw material, from US, right? From US, and you sign a contract, to pay money after 90 days, right? After 3 months, right? So that's, and you purchase a raw material right now. Right now, its value is $1 million, right? But of course, you haven't transferred the money. So you transfer money after 90 days. Right now, the value of buying is $1 million. So if it's spot market, whatever price is available on the date of payments, so you use that price to pay the money, all right? But under forward market, you sign a contract. So for example, you sign a contract to using a forward rate. Forward rate means predetermined rate, the rate we decided, right? For example, forward rate is 22,500 Vietnam dong, right? So you decided to make a payments 22,500. This is the exchange rates. This is the signed contract. Now, if spot market exchange rates is more than this price, you will make profit. Why? Because market price is, let's say, 25,000 Vietnam dong, $1, right? 25,000 Vietnam dong, $1. But you are paying just 22,500 Vietnam dong, $1. So your payments will reduce. As a result, you will have a profit. But if on this day, the spot market price is 26,000, no, sorry, if it's 22,000, so you're gonna have a loss. That's the ideas behind a forward market. So I repeat, under forward market, you sign a contract for future date and future price, right? We don't call it future price, so we call it forward price, right? Future dates, you sign a contract to pay, to buy or to sell in the future date at forward rate. So how we decide this forward rate? Forward rate basically is agreements between buyer and seller, or forward rate is available through the forward market. So forward market is going to give you future price, so you can use that price. So that's the ideas for the forward market. It also sounds like hedging. You know hedging? Have you studied hedging before?
Yes.
So it's exactly like as hedging. You enter in a contract to make a payments in a future at forward rate. If forward rate up and down, you have a profit or loss, right? So remember, there is not always win-win situation under this forward markets. There is not always lose-lose situation. In market, we have buyer and we have seller. If buyer is a winner, seller will be loser. If seller is winner, buyer will be loser. All right. So that's why in this market, there is a win and lose situation. All right. So it completely depends upon the whatever price is available in the future market. This is very basic ideas to understand what is the meaning of spot markets. All right. Okay. Now, another few things you need to understand about forward market. If we say long position, the word long position means we are buying, we are a buyer, right? And short position means we are a seller, we are selling, right? We are buyer, we are seller. So long means buying, short means sell, right? Buy and sell. So remember the word long position and short positions, right? Okay. So the conclusion is, if you want to estimate profit or loss in your long or short position, then you always have to compare, spot price, let's say it's dollar pounds, spot price with forward price, dollar and pound. This is exchange rates. So S stand for spot price, F stand for forward price. All right. So again, in the short position, you are seller. All right. Under short position, you are seller. If you are seller, what do you want? Local currency should be weaker or should be stronger if you are a seller? If you are a seller, what do you prefer? What do you expect? Local currency get weaker is good for you, or local currency stronger is good for you? Tell me, if you are a seller.
I guess stronger.
You want local currency stronger?
Yeah.
Are you sure?
Sure.
If local currency is stronger, you should buy, because foreign currency cheaper. All right. If local currency stronger, you should buy, not sell. Because when you sell, you are selling in foreign currency, not in local currencies. You're gonna earn foreign currency. If you earn foreign currency and local currency stronger, you earn less foreign currency. All right. So answer is opposite. Right. So If you are a seller and spot rate going down, you will make profit. Remember, you are a seller, spot rate going down, you will have a profit. Why? Because you did not sign contract with spot rate. You signed contract with forward rate. So you always compare spot rate and forward rate. If spot rate is getting weaker, you are making more profit if you are a seller, right? Because you want to sell expensive, but spot rate is low, so you're making profit. The people involved in spot rate, they are losing money. The people involved in forward rate, they are making money. Exactly opposite. The people making money in a short rate contract, they will make money. Vice versa, the people involved in a forward contract, they will lose money. All right, so as I said, it's always been a lose situation from one market to another market. In the long position, if spot rate goes up, you will make profit or loss in long position?
Profit.
You will make profit because spot rate is getting expensive. The people involved in spot rate, they are losing money, but you sign a contract in a forward market. So that means you will make a profit, right? So remember these two things, right? So buying and selling position, spot rate up and down lead to profit and loss, and short position, spot rate up and down lead to profit and loss. And always compare. To estimate profit and loss, compare the price of spot market with the forward market, right? So let's move on to the slide. So we're gonna study various things. So let's directly jump to the information besides reading slide by slide. So remember, you know that future at agree upon today, future price. So banks give us quotation for 1 month, 3 months, 6 months, 9 months, and 12 months maturity. So means bank are offering us forward rate for 1 month. After 1 month, this is the rate. After 3 months, this is the rate. After 6 months, this is the rate. So you will use these rates to trade and compare with the spot. Spot means the rate is available every day, daily price. All right. So remember, forward, under forward market, banks give you quotations. Bank will give you the future price. For 1 month contract, this is the price if you enter in a 1 month contract, if you enter in a 3 months, if you enter in a 6 months, if you enter in a 9 months. Right? I want to show you one thing. When we start this topic in the beginning of the slides, so there was a one slide, so I want to show you. In that slide, you can see the spot price and the forward price. Very first slide about direct quotation. Here, direct quotation. Can you see this? Okay, let's see here. Canadian dollar, this. Remember, this is a spot rate and 1 month forward, 3 month forward, 6 months forward. These three rates are forward rate. So you can see that 84, 86, 88, 79, 16, 14, 12, 21. So they are not same. All right. So if you enter in a forward contract in the future, you compare this price with these price to find you have profit or you have loss. Same thing with the indirect quotations. All right. So this is the best example to understand spot price and the forward price. So next time when you have a chance to go to bank, you can check. Bank also provides you current price and the forward price. So you can see on the screen, the bank also giving you a current and the forward bank. But it depends upon mostly international banks in Vietnam, like as Commonwealth or ANZ. These banks most likely to give you these kinds of rates, but the local bank, so they're less likely to give you these kinds of informations, quotations. Right? So this is the best way to understand the difference. So this is the contract. So if you are entering in a 3 months contract, you use this rate, right? If you're entering in a 6 months contract, you use this rate, right? So if you are entering in a spot, you use this rate, daily price. This is change every day. And this one will be fixed for 1 month. After 1 month, change. After 3 months, change. After 6 months. So maturity is 1 month, 3 months, 6 months. And its maturity is a daily maturity, daily or timely, not fixed. All right, so this is the ideas to understand the forward and the spot rate. Let's go back to the forward rate again. So here, so this is just a very basic information that I asked you before. According to forward rate, when pound, so let's read this one. Consider these exchange rates. For British pound, the spot rate is 1.9717 for 1 pound. So value of 1 pound equals to $1.9717. For 180, this is spot, right? Spot, this is spot rate. And for 180, I guess it's here. Yes, it's here. 6 months is a 180 days. Right? So 6 months rate is 1.9593, right? So this is the spot rate and this is the forward rate. Now, according to forward rate, when pound is trading at discounts, discounts means lower price, lower than the spot price, to USD in America, we can say the market expect the USD to appreciate. It means if USD appreciate, we will get less GBP, means we will make more profit. All right, I repeat, compared to USD, if British pound is trading at discounts, so remember, premium, discounts. Premium means lower than the market value or lower than the contract value. So this is the contract value, which is forward rate. If it's trading at discounts in spot markets, so which means if you are getting position in USD, it's good for you because pound less, so you get more USD. All right. If pound is trading at premium, premium means higher than the spot price. So if you trade in USD, you will make less money because pound is a stronger. So your local currency is a Vietnam dong. Same example. Local currency is a USD, American dollars. Right? If pound is getting weaker, right? If pound is getting weaker, good for you. If pound is getting stronger, bad for you in terms of buying, right? So that's the ideas. So we compare spot price with the forward price. So let's move on to the real understanding. And remember, we normally estimate profit and loss using the graph. So next slide, I'm going to show you the graph. This is the forward rate quotation. Discount means making a loss. So don't worry about this one. This slide is just about what does it mean, discounts. Discount means lower than the spot price. Means you're going to lose money. Lower than the contract value. And premium means making money, higher. Discount lower, premium is higher. So that's just not important. Just leave it. It comes to the main. If you sell short, buy long, right? Sell short, buy long. That I already explained to you before. Next. Now, this is the graph that we can understand. This is short position. Short means sell. If you agree, so F stands for forward, S stands for spot, right? So this is the forward rate, 0.009524. If you agree to sell anything in future at set price, the spot price later falls, then you gain, right? If spot price is fall, spot price goes down, but you agree to sell at this price. So it's good for you. You are making a profit, this one. You are making profit here. If spot price fall, all right? If spot price rise, all right? Which means you are selling, but spot price is higher than the forward price, then you're gonna have a loss. So let's say here. So maybe here. Then you're gonna have a loss. So profit and loss again depends upon the movement in the price. Right? Price could be increased, decreased, any kind of changes in the price. Right? If prices goes up or goes down or any kinds of situation. So remember, this area for loss and this area for profit. So with the help of graph, we can understand. If price goes up, spot price goes up, we're gonna make a loss. If spot price goes down, we're gonna make a profit. So I think next slide gonna explain in such way. So again, short position. Short position means you are selling position, right? You are in selling position. So that was also short position too. This was a selling position. If stock price, spot price rise, the example I gave you here, same example here. Same example here. If spot price rise, spot price goes up, we're gonna have a loss. We can understand this loss with the help of another graph, like this graph. They are doing the same thing. Spot price up, you will lose. I think loss is the loss. Where loss? I think loss should be somewhere here. That's loss. That's loss. If spot price goes down. So every time you compare spot price with the forward price, right? Spot price after 180 days, all right? And forward price you sign before that date, that the price you are expecting, right? So every time, if forward is 30 days and you compare the forward 30 days is spot 30 days, the price of currency on the 30th day, and then you will find profit or loss, right? So this is short position, selling position. Now, same thing, spot price give rise or fall. So let's move on to the next. Okay, it's same thing, profit. So let's say if in 180 days, spot 120, the short will make profit by buying this and sell at this, right? Buying at this and sell at this. So what does it mean? It means the difference of the spot 120 and 105, 15 is a profit. So what does it mean? It means if you are entered in a contract to sell something at 120, all right? No, sorry, you enter in a contract long position. It's a long position. You are buying position, all right? You sign a contract to buy at 105. For example, the price is Japanese yen 105, but this is for forward. And spot markets gives you price 120 at this day. So what does it mean? You already signed here. So which means it's a cheaper compared to forward market. So that's why, how much is the difference? 15. 15 is a difference. So that's why you are making a profit, 15. All right. Same thing with the long positions, or sorry, short positions. So idea is that we can easily understand long and short by looking at the comparison whether we are buying or we are selling. Let's move on to the real question. Here is a hedging. So that's called the hedgings that I explained you in the beginning. So here is a question. You are a US importer of British woolens and have just ordered next year inventory. Payments of 100 million pounds due in 1 year. So in 1 year, you're gonna pay 100 million pounds. If you do not enter in a spot, whatever price is available after 1 year, you use that price to make a payments. Price could be high or price could be low. If price is low, you're gonna make profit because you are a buyer. If price goes up, you have to pay more, right? Second option is that you enter in a forward contract for 1 month, 3 months, 6 months, or 12 months. So same thing here. So this is the exchange rates, 1.95. This is the forward rate. You sign a contract with this rate. So this example is about spot rate. Remember, this example is about spot rate. So what does it mean? You sign a contract with 1.95. If you are involved in unhedging, this is for unhedging. You do not involve in unhedging situation. If you are in an unhedging situation, you don't hedge, you don't sign. Hedging means entering a contract. If you are not entering in a contract, if exchange rate goes up, so this is this line for spot, right? So this axis for spot, x-axis, spot rate. So if spot rate is increasing, spot rate increase, and you are in a unhedging position, spot rate increase, you will lose money. How much lose? You're supposed to pay 1.95, but is paying rate is 2.25. So what does it mean? So you are paying 0, sorry, it's 30. Sorry, I'm being wrong. So it's 30. All right. So you're gonna paying 30 extra because rate was this, but spot rate price increase. So you are paying that. But if you enter in such kinds of hedging, sign a contract, if spot rate going down, all right? If spot rate going down and you are in unhedging position, you will make a profit, right? So if your price goes 1.65, remember, this is for unhedging. You are not entered in any kinds of contract. If price goes down at the time of payments, you will make a profit, which is difference, this and this. If price goes up, you're gonna make a loss, which is this and this, which is 30 million. So this is spot market, unhedging payable, not involved in any kinds of hedging. But now it's a hedging. You involve in a hedgings. If you involve in a hedging, if price increase, you will make profit because price increase means spot price. This is spot price. Spot price goes up, you will make a profit. Spot price goes down, you will make a loss because you are paying this price. So this is the example to understand the benefits of having a hedging. But again, hedging is not always profitable. If one-sided is profitable for one party, for another party means spot rate parties gonna have a loss. If spot rate party gonna have a loss, forward rate party gonna have a profit because we are comparing with each others to find the profit. So this is all about hedging. So same thing. So unhedging, you involve in unhedgings, or you involve in hedgings. So hedging is gonna be profit or loss, and same thing, unhedging also be loss or profit. All right. So hedging and unhedging opposite to each other. So one position, remember, gain on one position are offset by the loss on other position. So which means if one position is giving you loss, if you want to make profit, you have to switch to another position. If short position is giving you profit, or sorry, short position is giving you loss, then you have to enter in a long position to offset the loss, to cover the loss. All right, so that's the ideas. All right. If you're planning to, but you involve in import and exports, both to one country. If you export and you're having a loss, so you have to maximize your import to that country so you can recover the loss of export. So that's the use of such kinds of hedgings or such kinds of trading to offset the loss and profit from two different positions, buying a long position or short position. So that's all about forward markets. All right. Any questions regarding forward market? Is it okay?
Yes.
Okay. So next is swap and ETF, exchange traded currencies fund. So swap, so don't worry for swap right now, because this swap we will study in our next topic, which is topic 5. I already sent you slides for topic 5. So topic 5 is triple P, purchasing power parity. Right? So that's also interesting, using the exchange rates. So under triple P, purchasing power parity at international level, we will look at this swap. So right now, I'm not gonna discuss this one. Next is ETCF, exchange traded currency fund. Its exchange traded currency fund is same like as a stock. So one ETF equals to one stock, but that stock is not a company stock price. That stock represent the lot of currencies, currency lot. So let's say one ETF equals to, so ETF represent the share in 100 euro, right? One ETF in euro equals to 100 euro currency, right? So ETF is just, instead of buying a single euro, we buy a bunch of euro. If you are, so ETF is the best way to invest a lot of money in foreign currency. The people who are willing to buy and sell a lot of foreign currency, ETCF is really good for them. ETCF is not really good for them who buy and sell foreign currency for travel purpose, for spending purpose. So ETCF is good for the investment point of view. But remember, ETCF is not available in every country. It depends upon currencies to currencies, country to country. For example, 6 additional currency trusts exist on Australian dollars, where you can buy ETCF. For British pound, you can buy Canadian dollars, Mexican peso, Swedish krona, or Swiss francs. So for these currencies, you can buy ETF from New York Stock Exchange. You can buy it. So it's just to understand if somebody is portfolio investors in relation of foreign exchange, then this is the best way, ETCF. Otherwise, if you just want to buy and sell just to traveling purpose or just for spending purpose, then that may not be suitable for you, right? So I think that's all for this topic. So topic 4 is finished. So any questions for topic 4?
Teacher, for the question 10 in page 135, can you send me the solution for
Yeah,
that
I will
question?
send you solution. I was working in a break time, but I haven't finished yet. So I will finish it off. Then I will send you this video and the solution together for all exercises. I think I gave you 3 activities, right? 3 or 2?
Two. Two.
2. So I will give you solution for these 2 activities. Right.
Yeah.
So any other question?
No.
No question. So we stop here.
Teacher,
Yep.
can I ask you when you will give us the midterm assignment?
Midterm assignment. I think when we finish topic 6. So topic 1 to topic 6. Because next topic 5, about calculations, and topic 6 also about calculations. So once we finish topic 6, then week later or on the same day, you will have assignment, and then I'll give you maximum 2 weeks before you finish the last lecture. So before last lecture, you will submit your assignments to me online. All right. So wait for topic 6. All right. Any other question?
No.
No questions. So we stop here. So I'll see you next week, Tuesday morning. Thank you. Bye-bye.
Okay, thank you.
Bye.
Bye-bye.